Welcome back everyone to another episode on Ang's channel. Today we starting a new learning series. We are going to look at some economic factors. Today we're going to see what exactly is CPI. So let's get right into it. So CPI, also known as the Consumer Price Index. So this CPI actually indicates that the growth of price for the goods, including the foods, our clothes, houses, as well as cars. So imagine 10 years ago. 10 years ago, we have a bottle of drink which you really like. It costs actually 1 ringgit, and right now, this bottle of water actually costs 2 or even 3 ringgit. So this is what we call the inflation. So CPI actually records how much growth of our products, of our goods, which indicates what situation of our economics are in. Is it inflation, slow inflation, high inflation, or deflations? So in this case, CPI value of high value indicates a inflations, which is called 通胀 in Chinese, or 通货膨胀. And if the CPI value is low, it's actually saying that we have slow inflations, or we can also say it's in the deflation mode. So what exactly this CPI actually affects the market? Well, here's the thing. If CPI increases, meaning that we are actually in the status of high inflation, so the price of the goods are very expensive, are growing in very fast pace. So this is where our central banks or federal governments, for example, in the US Fed, or in Malaysia is the Bank Negara, they will actually increase the interest rates. And for the low CPI situations, which is indicating low inflation, deflations, the bank or the central bank will decrease the interest rates. And for CPI, high CPI means that inflation, right? So for example, if we have 3%, the goods of the product is increasing in the rates of 3%. So thus low CPI such as 1%, meaning that the price actually drops in the terms of 1%? No, it's just that low CPI indicating the price of the goods is decreasing in a slower pace. So compared to 3%, 1% is a healthier level, whereby the price of the goods is increasing very slowly, which can actually meet the growth of our salary or growth of people's businesses. So over here, we'll be looking at the historical data for CPI in both Malaysia and US. And over here, we can actually observe the latest one is actually at a level of 1.2%, which is quite healthy in the sense that the price of our goods is increasing very slowly, and we will be able to maintain it within the year of 2023 until now, staying very steadily below the 2%. Well, as for the US market, their CPI value is relatively higher at 2.7%. However, it does not mean they are actually in a bad situation. You can actually see from their historical data indicating that, hey, the US also being able to have a very stable value and almost reach their desired target, which is 2%. And for recent announcement from Jerome Powell of Fed, they're actually expecting 2 rate cuts in the coming September. So this might be a driver to the stocks, and we're going to explain this part right now. So after looking at what is CPI, the historical data, what actually does the CPI do to affect our market? So when there's inflation, CPI is high. So when CPI is high, so this is the case of inflation. When CPI is high, meaning that the Fed will increase the interest rates. So what does it mean by increasing the interest rates? The currency strength is becoming stronger. The stock will also become low or have bearish momentum because of what? High rates, meaning that the borrowing cost is very expensive. So this is somewhat like restricting the business to borrow money because it becomes more expensive in order for them to expand their businesses. And since when the interest rate is high, people are willing to save the money, meaning that because of the high interest rate, meaning people are willing to put their money into banks, into FD rates to increase their returns. And because of that, the fixed rates for the REITs as well as bonds become less attractive, meaning that the price and the bonds of the REITs will become lower. As for another case, which is low inflation, what does low inflation means? We have CPI value very low, the price of the goods is increasing very slowly, meaning that the Fed will likely to reduce or cut rates, meaning that the strength of the currency will become weaker. The stock will have a great sentiments because of what? Low rates means to have a cheaper borrowing method. So people or the company businesses will have a better opportunity to borrow with a lower cost to expand their businesses. And also people will have a low rates which actually drives them to buy cars, buy house, and also luxuries. And because of the rates or the bank's FD rates become low, the saving kind of method does not actually attract people, so people will likely to spend in order to heat up the economic. So also, when the rates of the bank decreases, the REITs interest as well as the bonds interest become more attractive. So this is where the price of the REITs and bonds will go up because people are willing to invest in assets that has better returns compared to the banks that actually offers, which they just face decrease in terms of the interest rates. And lastly is that how does this interest rate adjustment actually helps in balancing the value of CPI? So for example, we have high CPI will result in increasing of interest rates. So as we mentioned, increasing of interest rates will likely to cause the borrowing cost to become high. So that is why the company will actually reduce their borrowing, which will actually restrict their method or their growth of expanding their companies. And as well as the bank's FD rate also increase, would actually drive its people to save money. And for another case, which is low CPI, will result in decreasing interest rates. So this is where the borrowing becomes cheap. So this allowed a lot of company, factories, stocks to borrow different loans at a very cheap price in order to expand their company. And also, people will say, hey, the interest rates of the bank is very low. Interest rate is low. So meaning that saving money at the banks will bring low returns. So people are willing to spend rather than save. So this is why it will actually drive the economy and make it become hot again. So it's a difference of stabilizing, whereby if the inflation or CPI value is high, meaning that the economy is very heat up, we want to cool down the economy a bit, we increase the interest rates, restrict a bit the expenses of people. If the economy is very cold right now, the low interest rates actually allows people to borrow money at a very cheap price to expand their business, buy cars and houses, would actually drive people to spend instead of save. So I guess that is all for today's video about CPI, and you are interested about it, you can actually go further deeper to better understand these economic factor as well as its effect on different such as the currencies and so on and so forth. And if you like this video, you would like to support me, subscribe to my channel, click on the thumbs ups, share this video to your friends, and I guess I'll see you guys on the next one. Goodbye.